Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Albertsons stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 11 billion market cap. They're trading at $20 a share and they have 570 million shares outstanding. This company operates food and drug stores in the US. It sells grocery products, general merchandise, health and beauty care products. It has a pharmacy, it sells gasoline, etc. They also manufacture and sell their own food. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. That doesn't look that good. It was $2.3 billion in 2021, down 16% to $1.9 billion in 2022, down 63% to $700 million in 2023, down another 10% in 2024 to $628 million. They completed their 2024 fiscal year. Their fiscal year ends 2/29. Well, this year 2/29. Next year 2/28. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that nearly doubled from 2021 to 2022, down a little bit into 2023, down 14% into 2024. Really low margins like most supermarkets. Net profit margin 1 or 2%. Revenue is the sales for the company, and that goes up each year from 70 billion to a little under 80 billion. They have a really attractive price to sales ratio. Price to sales is stock price over sales per share. So it's 20 over 140 or 1 over 7 or about 0.15. They pay a pretty nice dividend, 2.4%, and that cost them $277 million. To calculate that dividend payment, you take their yield times their market cap. And you can see their free cash flow is over 600 million. So they can afford this dividend more than twice. As you can see right here, free cash flow over dividend 2.3. If this number was below 1.5, I'd be concerned they would cut their dividend. But if it's above a 2, I feel pretty safe they can maintain that dividend payment. And they had pretty low free cash flow in 2024. You can see it was 2.3 billion in 2021, so they can easily afford it back then. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 27 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $23 billion. We divide that by 600 million shares. And we get a calculated stock price of 40 bucks. They're trading at 20, so they're trading at a 51% discount. It's a really strong buy according to the model. And I think it will go up even more when they merge with Kroger. Generally, when a company gets acquired by another company, the stock goes up. But the company buying the other company, the stock goes down. There are 12 companies in the same industry as ACI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 1.8 billion. When they open up a new warehouse, the cost to build that warehouse goes in the CapEx. A really high debt to equity ratio. For every dollar of equity, they have $5.20 of debt. So really leveraged. They pay a nice dividend, 2.4%, the same as Kroger. They generate a good amount of free cash flow, 628 million. Sendas, the Brazilian company, generates more with a much smaller market cap. That's probably why Sendas has the best price to free cash flow ratio on this list. Albertsons is number 2 in market cap, a bit ahead of Sprouts, far behind Kroger. They're trading at 4 times book value, 9 times earnings, which is a really attractive price to earnings ratio, 18 times free cash flow, not as good as Albertsons, but better than Sprouts, 0.1 times revenue. Pretty much all supermarkets have a really attractive price to sales ratio. They generate a lot of revenue, a little more than half of Kroger. So they generate less revenue in dollar terms, but more revenue as a percent of their market cap because their price to sales is better. And their 5-year annual revenue growth rate is 6%, equal to the median. Go is number 1 at 12%. If you put $10,000 into this company when they started trading in 2020, after a couple of years, you would have more than doubled your money. But it has come down since then. You'd be at $18,000. That's assuming you reinvested the dividends into this company, which is a really good annual return, 16%. Let's take a look at their financials. Here's their income statement. And this is from their 10K since they completed their fiscal 2024 year. Their fiscal year ends at the end of February. So revenue went from $72 billion in 2022 to $78 billion in 2023 to $79 billion in 2024. Let's see if they give a breakdown of the revenue. Of the $79 billion of revenue, $40 billion is non-perishable, which is about half their revenue. That consists of general merchandise, maybe like gum, grocery, maybe like canned soup, dairy, and frozen foods. Fresh food is $25 billion, 32% of their revenue. This consists of meat, deli products, floral, seafood. Pharmacy is $8 billion, 10% of their revenue. You can buy gasoline at some locations, $4.4 billion, and other, $1.2 billion. Other is down from last year. So is fuel. Pharmacy went up the most. It was under 9% of their revenue, and now it's close to 10.5%. Other consists of sales to third parties, commissions, rental income. This income statement shows everything as a percent of revenue. Cost of revenue, 72% of revenue, $57 billion, which has gone up over the years. It was 71.2% in 2021, 72% in 2022. So their gross margin went down. It was close to 29% in 2021. Now it's close to 28%. Gross margin is gross profit, $22 billion over revenue. And they give more detail down here. Gross margin is net sales after reducing cost of sales. The costs include purchasing and sourcing. They have to buy the products. Inbound freight, the cost to ship the products. They do product quality testing to make sure the products are good. Warehousing and distribution costs. The products they manufacture are called own brands, OWN. Advertising expenses are also part of cost of revenue. So they talk about their decreasing gross margin. Gross margin decreased 20 basis points. The decrease was driven by pharmacy operations, increases in shrink, and increases in picking and delivery costs, partially offset by our procurement and sourcing productivity. Procurement is sourcing, finding products. The gross margin decrease in 2023 is related to pharmacy operations, mainly due to growth in pharmacy sales and a lower margin on COVID-19 vaccines. Everybody has to blame COVID. Selling and administrative expenses are really high, almost $20 billion, 25% of their revenue. Selling and administrative expenses, some people call it SG&A, are store-level costs, including wages, employee benefits, rent, depreciation, utilities, also back office expenses related to their corporate and division offices, because they have corporate offices all over the country. That's where the accounting staff works, the legal team works, HR. Selling and admin expenses remain flat at 25.2%. They passed through a loss of $44 million. Let's get some more information on that. The loss of $44 million was from the impairment and disposal of certain technology assets, partially offset by gains from the sale of assets. I was hoping they would give more detail, exactly what asset that is. In 2022, they had a net gain on selling property and an impairment loss of $148 million. That was driven by a gain of $153 million on the sale of real estate assets. So they may have sold some of their warehouses, partially offset by $5.1 million of asset impairments. An asset impairment is when you reduce the value of an asset on your balance sheet and pass through the loss onto your income statement. So their operating income is $2.1 billion, which is 2.6% margin. Operating margin is operating income over revenue. It's the percent of your revenue you convert to operating profit, which is lower than prior years. It was 3.3% in 2021. Interest expense, nearly $500 million. That's 0.6% of their revenue. The increase in interest expense was due to lower interest income. Interest income is the interest they receive on their investments, as well as higher debt outstanding and higher interest rates. The interest rate they pay on their debt is 5.6%. Last year, 5.3%. And they passed through a gain of $12.2 million on other. 2 years ago, they had a gain of $148 million. All the numbers below revenue are assumed to be expenses, so they're positive. So that means you reduce it from your revenue. But when an expense is negative, it's a gain. That's why I say gain when it's in parentheses, because it's a negative expense. Here's more detail. Other income was $12.2 million. That was from the gain on the sale of El Rancho. They carry El Rancho as equity method investments on their financials. A company uses equity method accounting when they own between 20 to 50% of another company. Their equity method investments include an interest in Mexico Foods parent and La Fabrica parent, El Rancho, a Texas-based specialty grocer. El Rancho exercised its option to repurchase the company's 45% ownership interest in El Rancho. So that means El Rancho used the option to purchase back their shares from Albertsons, and they paid $166 million for that option. As a result, Albertsons realized a gain of $10.5 million during 2023. Other things are part of the $12.2 million gain, not just El Rancho, but El Rancho was the bulk of it. Income before taxes, $1.6 billion. They paid $300 million of taxes, 0.4% of their revenue. Income tax was $293 million, which is a 21.8% effective tax rate. The effective income tax rate was driven by incremental benefits in the reduction of reserves for uncertain tax positions, primarily due to the expiration of a foreign statute during 2023 and additional federal tax credits. I'm not going to explain what this is now, but that would be a good thing to talk about on the live stream. And their net income was $1.3 billion, down from prior years. Earnings per share, $2.25. On a diluted basis, $2.23. On the bottom of this page, they have a chart showing how they went from $77.6 billion to $79.2 billion. It's a pretty interesting chart. Let's take a look at it. Sales in 2022, $77.6 billion. Identical sales, which means sales of the same product they sold this year and last year, went up $2.2 billion. That's due to inflation mainly. There was a decrease in fuel sales because of the price of gasoline went down. And then they closed some stores. That was a decrease of $1.2 million of sales. And then you have all the miscellaneous items, negative $115 million. So that's how you get from 22 to 23. Let's take a look at the statement of cash flows. This shows the 3 fiscal years. So in 2024, operating cash flow $2.7 billion. It goes down each year from 3.5 to 2.9 to 2.7. A big reason it's going down is because net income is going down. Operating cash flow is net income plus the non-cash items on the income statement, like depreciation, $1.8 billion. We have to add back equity method compensation. It looks like they passed through a loss of $105 million on their equity method investments, so they're adding it back here. That means some of the companies they invested in had negative net income, so they passed through a loss on their income statement. But that's a non-cash item, so we add it back here. But if they receive dividends from their investments in other companies, that is a cash item. That would not get adjusted on the statement of cash flows. We have to adjust for changes in working capital, a cash outflow of $650 million from operating lease liabilities, because they lease some of the warehouses they operate in. They don't own all of them. In PP&E, they had a cash outflow of $2 billion, a cash inflow of $218 billion on the sale of assets. In their financing section, they had a cash inflow of $150 million, taking on long-term debt. They paid down $950 million of long-term debt. Last year, they paid a $4 billion special dividend. So if you were a shareholder, you probably were really happy you got that dividend. I remember when ACI IPO'd, and I think I was going to buy the stock. I actually may have bought it and sold a few months later. Maybe I should have kept it. They paid $276 million of dividends. Here's my Excel file. Remember I said their dividend payout is $277 million? Only $1 million off. Actually, I was right on target because they paid out $800,000 in preferred dividends. 276.2 plus 0.8 is 277 exactly. And when they give employees stock, they have to pay taxes on that. They pay $39 million of taxes. And I don't see any stock buybacks. I'm surprised they don't buy back stock. Let's look at the company on Simply Wall Street. Its last price, $20, 11.4 billion market cap, up 1% in the past week, down 9.5% in the past year. They started trading in September 2020 at $16. After 18 months, it was up about 120%. Then it had a big dip, then jumped right back up. That was in March 2022. After that, the stock struggled quite a bit. So for the next 2 years, it pretty much kept falling. How much further can it fall? I don't think it get into single digits. I don't think it'll fall below 10. I can see 12 or 13 maybe. But when they merge with Kroger, it may change things up a lot. Simply Wall Street's value is 49. They say they're 60% undervalued. 13 analysts priced this stock at 25 bucks. That's their 1-year price target. And this purple line is the analyst price target. So the target was $34 in May 2022, and it seems to be coming down every few months. This blue line on the top is the company's revenue target. 6 analysts project their revenue to be $83 billion by 2027. The purple line on the bottom is their free cash flow target. 2 analysts project $1.5 billion by 2027. They had $11 billion of debt in 2016, but that was the peak. It looks like they're trying to cut down their debt. They trim a little bit each year. It's currently $7.6 billion. Their equity is a lot lower than their debt. Currently their equity is $2.7 billion. That's why they have such a bad debt to equity ratio. And this green line is their cash. They only have $200 million of cash on their balance sheet. Troubling times indeed. Their dividend back in 2020 was 2.6%. Then it fell to 1.5%. It's back up to over 2%. And the forecast is 2.4% by 2027. The CEO salary was $1.3 million in 2020. Now it's $1.5 million. Vivek Sankaran is a CEO. Total compensation $15 million. Tenure as CEO 5.2 years. My wife and I have been watching this pit bull for years. We used to watch a lot of dogs, but we only have one left. The owner of the dog is Vivek. In the past year, 2 insider sells, no buys. 57% of the company is owned by institutions, 26% by VC and private equity firms, 8% by the general public, 5% by private companies, 4% by insiders. Cerberus is the biggest shareholder. My friend used to be the CFO at Cerberus. That's a private equity firm in Manhattan. Vanguard is the next biggest shareholder, 6%. The REIT, Kimco, 5%. Kimco is also about $20 a share, 13 billion market cap. They pay a 5% dividend. They're a retail REIT based out of New York. Jericho, New York is in Long Island, growing revenue from $1.1 billion to $1.8 billion. Schottenstein owns 5%. Schottenstein also owns DSW, and they also own a pretty big chunk of American Eagle. Then you have BlackRock, 3.5%. Jay Schottenstein, the guy who runs Schottenstein stores. Norges, the Norwegian bank. Goldman Sachs, Barclays, a UK company, owns 0.68%. JP Morgan, 0.6%. Their employee count went from 270,000 in 2017 to 300,000 in 2021, but it looks like they're trimming that down to 200,000 currently. The ticker trades on the New York Stock Exchange, Deutsche Börse, and Xetra. Let's learn about the history of this company. Joe Albertson founded the company in 1939 in Boise, Idaho. That's currently its headquarters. The store had perks, and at the time, these were brand new perks. Free parking, a money-back guarantee, and also an ice cream shop. His first store was an enormous success, and he invested his profits back into the business. New stores were opening in neighboring towns, such as Caldwell and Emmett. He became a publicly traded company in 1959. That's 65 years ago. And he continued growing and expanding. His 100th store was in Seattle in 1963. In 1964, he expanded to Southern California by acquiring All American Markets, a small chain based in Orange County. In 1967, he expanded into Colorado when he acquired 8 stores from Furr's Supermarkets. By the end of the 1960s, he had 200 stores. In 1969, he partnered with Skaggs Drug Centers to create the first combination food and drug store. The first one was in Texas. In 1973, he opened his first distribution center in Brea, California. He bought Fazio's shopping bag in 1978 from Fisher Foods, adding 46 stores to Southern California. In 1981, he entered Nebraska and South Dakota. In 1988, he built a distribution center in Portland, Oregon. His 500th store in 1989 was in Temecula, California. He expanded heavily in the 1990s. He acquired American Stores, which had locations in Texas, Oklahoma, Arkansas, and Florida. In 1994, he acquired 4 stores from San Diego County chain Big Bear Markets. In 1997, he added Albertsons Express, which included a fuel center and convenience store. The first one was in Eagle, Idaho. In 1998, the acquisition for American Stores went through, which controlled Acme, a grocery store chain with locations in Pennsylvania, New Jersey, Maryland, and Delaware. American Stores also included Lucky in California, Nevada, Jewel Osco in Illinois, Indiana, and Iowa. That was their biggest acquisition to date. They were the largest American food and drug operator with over 2,500 stores in 37 states. But the following month, Kroger acquired Fred Meyer, and Kroger was number one. In 2001, the CEO said they would close 165 underperforming stores across 25 states. And of course, they had to cut a lot of jobs. Also, the distribution center in Tulsa, Oklahoma was sold to Fleming Companies. After they finally stabilized their finances and consolidated their divisions, they acquired Shores Supermarkets and also Star Market from Sainsbury's for $2.5 billion. Albertsons also purchased Bristol Farms for $135 million. During the same time, they exited the markets in Omaha, where it closed or sold 21 stores. They also closed 7 stores in New Orleans. And then around 2006, they were purchased by Cerberus. Cerberus had some big investors like Kimco, Schottenstein Stores, Claff Realty. Cerberus wanted Albertsons to be more lean. SuperValue acquired 1,124 stores from Albertsons. CVS acquired 700, so there's only 655 Albertsons left. After that sale to Cerberus, the stock was removed from New York Stock Exchange. They continue to make the company leaner. They announced in 2006 they were selling all their Northern California and Northern Nevada stores to Save Mart. In 2008, the company began exiting the fuel business. They sold 72 of their gas stations to Valero Energy. Albertsons had been restored to profitability. In 2013, SuperValue sold their stores back to Cerberus. In 2013, they acquired Lubbock-based United Supermarkets. In 2014, Safeway wanted to sell itself, and they were in advanced negotiations with Cerberus. Cerberus said they would acquire them for $9.4 billion. Shareholders of Safeway approved the merger. In January 2015, the deal went through. Albertsons acquired Safeway, which included Randall's, Tom Thumb, Carr's Safeway, Vons, and Pavilions, plus Safeway's 49% share of Casa Ley, a Mexican grocery chain. Albertsons wanted to IPO in 2015, planning to raise $1.7 billion by selling 65 million shares ranging from $23 to $26. But the company postponed the listing due to market conditions. But even though they postponed the IPO, they continued to expand and buy stores. They purchased 70 stores from the bankrupt company Great Atlantic and Pacific Tea Company. And those stores operated under the brand names The Food Emporium, AMP, Superfresh, and Pathmark. In 2018, the company began to re-enter the fuel market, opening a brand new Albertsons Express in Boise, Idaho. In 2018, they announced plans to acquire Rite Aid, although shareholders were not happy and declined the acquisition. In October 2022, Kroger announced its intent to merge with Albertsons, with Kroger acquiring all Albertsons shares and divesting some stores. The $25 billion deal is expected to close this year. The announcement was met with criticism due to the potential monopoly. In February of this year, the FTC sued to block the acquisition. They said the deal would negatively impact prices and wages. What a bunch of bullshit. Albertsons currently operates 162 Acme markets, 381 Albertsons, 188 Jewel Osco, 127 Shores, 194 Vons, and many other brands. The average Albertsons is between 50,000 and 70,000 square feet, and they include a bakery, deli, meat counter, produce department, and seafood counter. Most stores have a bank inside and a pharmacy. Some of the newer stores have a Starbucks, in-store pizza, juice bars. I still rather shop at Wegmans over this store any day. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.